Hello, this week we are presenting the cost of capital for Nestle and GSK. We are going to compare their betas and their expected returns. A security's beta is related to how sensitive its underlying revenues and cash flows are to general economic conditions. Beta is an important metric used in capital asset pricing model to effectively calculate a company's cost of equity that in turn is applied in numerous valuation models. Beta is a measure of volatility or systematic risk which refers to the risk inherent to the entire market. We found that 5-year monthly beta to be 0.29 for both Nestle and GSK. A beta value of 0.29 means that stock is only 29% as volatile with its price swings compared with the overall market index. Another way to look at this is that the stock is 71% less volatile than the overall stock market. In order to calculate the beta of a security, the covariance between the return of the security and the return of the market must be known, as well as the variance of the market returns, where the first one is a measure of stock's return relative to that of the market, and the second one is a measure of how the market moves relative to its mean. Firstly, we used monthly adjusted close prices for Nestle and GSK historical prices for the past 5 years. The reason why we decided to choose the adjusted closed price is because it already has dividends corrected and stock splits corrected that make it more suitable in our calculations. Then we calculated the monthly stock returns for 5 years using the ln function of new price over old price. We use the 6 Swiss index and the London Stock Exchange to calculate the respective market returns of the firms. So we decided to compute beta using the slope for both stocks by using the slope function in Excel, and also use the covariance over variance formula to confirm that our results are indeed right. We found both betas to be positive and less than 1 with an upward trend. In order to be able to analyze more in depth the systematic risk of the two firms, we looked into the levered and the unlevered betas for the firms for the past 3 years. So levered beta measures the risk of a firm with debt and equity in its capital structure to the volatility of the market. The greater the proportion of capital that the firm raises from debt, the higher its equity beta will be. Theoretically, highly levered firms should have higher betas than firms with less debt. Unlevered beta is actually the beta of a company without the impact of debt. It is also known as the volatility of returns for a company without taking into account its financial leverage. Firms with lower fixed cost as a percentage of their total costs should have lower unlevered betas. Unlevered beta removes any beneficial effects gained by adding debt to the firm's capital structure. Comparing companies' unlevered betas give an investor clarity on the composition of risk being assumed when purchasing the stock. Since companies have different capital structures and levels of debt, an investor can calculate the unlevered beta to effectively compare them against each other or against the market. This way, only the sensitivity of a firm's assets to the market will be factored in. For the 3-year beta, GSK had lower betas compared to Nestle. For unlevered betas, GSK was lower by 0.12, whereas for levered beta, GSK was lower by 0.22. However, for each company, both levered and unlevered betas were lower than 1, meaning that a stock with a beta lower than 1 is expected to rise less than the market when the market is moving up, but also fall less than the market when the market is moving down. The higher the difference between levered and unlevered beta, the higher the importance of debt will be. If we look at the debt to equity ratio for GSK and Nestle respectively, we can notice that GSK has a higher one, and this actually explains the higher difference between levered and unlevered beta for GSK.
Explanation for low betas. Nestle is in the consumer goods industry, and GSK is a manufacturer of pharma products and is in the healthcare industry. Both GSK and Nestle have the same beta of 0.29, and both industries are considered to be non-cyclical, meaning that it consists of firms who are less sensitive to economic cycles. As people often use the products produced in both industries on a daily basis, so are often unwilling to cut them from their consumption, which strongly suggests that consumers may view these products as necessities. This may explain why consumer goods industries is low risk and has a low beta of 0.44. Nestle may have a lower beta due to the implementation of a diversified product strategy. The strategy consists of production in several categories in the food and beverages industry. The effectiveness of this strategy was highlighted in the COVID-19 crisis, with many industries suffering due to lockdowns imposed, with consumption of products in restaurants decreasing due to lockdown. However, this effect was offset by more home consumption in the case of Nestle, as customers would then purchase Nestle's alternative products that they can then consume at home while still in lockdown, which was then reflected with Nestle's earnings per share growing 4% in 2020. This would reduce their systematic risk as the revenues were effectively guarded against a macroeconomic fluctuation. GSK had the same beta of 0.29 as the industry is considered to be non-cyclical, as people require innovative vaccines and medicine to treat diseases and may be demanded regardless of the current economic situation. GSK specifically focused on a strategy consisting of the development of cancer, antiviral, and HIV treatment. This is evident in the healthcare sector having a low beta of 0.72, supporting the idea that the industry is low risk and will be less volatile than the overall market, as people will always demand healthcare regardless of the current economic situation, which was highlighted evidently in the COVID-19 crisis, with high demand for vaccines for treatment against the numerous viral variants of the disease, in which GSK collaborated with many biotech companies to increase speed of production to satisfy demand of effective treatment against the virus, which may be an explanatory factor as to why GSK has a lower beta of 0.29, similar to Nestle. For both industries, firms have low betas, below 1 at an average beta of 0.67 for competitors of Nestle, and an average beta of 0.49 for the competitors of GSK. Their low betas implies that they are non-cyclical companies, meaning that they are companies for which people will continue to consume their products even during an economic downturn. Since they are large and established firms, they have lower betas than smaller, young, unstable firms, but still, what is important to notice is that GSK and Nestle have lower betas than their competitors.
The capital asset pricing model is a model that describes the relationship between the expected returns and the risk of investing in a security. It shows that the expected return on a security is equal to the risk-free return plus a risk premium, which is based on the beta of that security. A key prediction of the capital asset pricing model is that idiosyncratic risk is not priced by investors because in the absence of frictions, it can be fully diversified away. Although the two stocks trade in different markets, the GSK one in the London Stock Exchange and Nestle in the 6 Weeks Exchange, they both have similar expected returns. However, both expected returns are lower than their respective market returns. This makes sense because both have a low beta. A beta lower than 1 means that the two firms have lower return than the market but also lower risk than the market. A stock's levered beta is equal to its unlevered beta multiplied by 1 plus the firm's ratio of debt to equity. Therefore, a stock's beta and its expected return increases as its debt ratio increases. The increase in beta reflects the additional systematic risk generated by financial leverage. The resulting increase in expected return reflects the increase in the financial risk premium required by investors as compensation for additional risk. As it can be seen, Nestle has a high return compared to GSK when using the 3-year levered and unlevered betas. This is because GSK has a higher debt to equity ratio, thus lower unlevered beta than Nestle. Both Nestle and GSK have low beta values, and hence why the low expected returns. So stocks with low betas move less than the market, pose less risk, and have low returns. Since the betas for Nestle and GSK are smaller than 1, the return they offer is lower than the respective market return. So we conclude that Nestle and GSK have low systematic risk, and thus they offer lower returns than other stocks. Both being two established non-cyclical firms, they are often considered as a safer investment and are often preferred by more risk-averse investors. Thank you for your attention. Please feel free to ask any questions you have.